Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss retirement's biggest threat, inflation. Specifically, I'm going to chat about turning on the retirement income tap, the impact of inflation and tax on your retirement income, the risk of being too conservative, why this is the greatest time to be alive as an investor, an inevitable truth every long-term retiree must face, and lastly, as always, a few action items for you to consider. Now, I know the word inflation has been thrusted into the public consciousness more than ever over the last few years, and for good reason. Things are more expensive, and you really don't need me to tell you that. Everyone can feel it. Now, during your working years, the hope is the income you earn either as a salary or as profits from a business increase year over year at a rate that will, at the very least, keep pace with inflation, which in Canada, the target inflation rate is around the 2% mark. However, when work stops and retirement starts, you no longer rely on an annual increase to your wage or profits from your business. You now enter a stage where your investments must pay you a stable income while keeping pace with your biggest retirement threat, inflation. Now, this can be an unnerving time for the newly retired as they've never crossed this threshold and are concerned about whether or not their money will last, let alone keep pace with inflation. Things can get especially dicey in those first few years if markets end up being volatile. Now, during these early years, the choices you make will have a material impact on your ability to stay retired. This is where building a plan that factors inflation, a stable income, and an inevitable market drawdown is crucial. But back to the main topic for today, inflation, and more specifically, how inflation impacts a retiree. Now, let's assume the average inflation you will experience over the next 30 years of your retirement is 2.5%, so slightly higher than the Bank of Canada's target of 2%. Now, let's say you had $1 to invest or not invest. If you decided not to invest that dollar over a 30-year retirement, that dollar, after 30 years, would be worth about 50 cents. A 50% loss in your purchasing power by keeping your money under the mattress. On the reverse, say you invested that dollar and earned around 8% with a 2.5% inflation rate. This means that your real rate of return, which is your return less inflation, is 5.5%. After 30 years, the purchasing power of the dollar you started with is now $5. If we apply these same estimates to a $1 million portfolio, this is the difference between having $500,000 in year 30 versus $5 million. Now, granted, I'm not including withdrawals in my example, but it helps to illustrate the damage that not investing properly can have on your long-term prospects of staying retired. Further to that, I'm not discussing another factor that applies further stress to one's long-term retirement, and that is tax. Let's discuss another hypothetical example of two couples, each with a $1 million portfolio. For ease of calculation, let's assume the full $1 million is in a taxable RRSP or RIF account, so fully taxable as income when withdrawn. We will also assume a 20% average tax rate, 2.5% inflation, an average 8% return in a retirement portfolio, a 4% return in a conservative portfolio, and an annual withdrawal of $50,000 before tax for income needs. Now, couple number one got spooked during 2021 and made some poor decisions with their money. They moved it all into high interest savings and GICs and plan to stay put because they think the markets are scary. They will earn 4% on average before tax and inflation. This means the after-tax real rate of return on their retirement nest egg is about 0.7%. Again, if we assume a $50,000 annual withdrawal, this couple will completely run out of money in year 20 of retirement. Couple number two took a balanced approach. They had a well-diversified, low-cost retirement portfolio built around a plan that shifted income withdrawals to stable investments during drawdowns. Their portfolio earned on average 8%, so less tax and inflation produced an after-tax real rate of return of 3.8%. Assuming the same $50,000 annual withdrawal, this couple's money will last nearly 40 years. So let me ask you, what's scarier? Watching your portfolio go up and down or running out of money at age 80? The bottom line is, being too conservative will destroy your retirement. If you open your retirement statements and all you see are GICs, fixed income mutual funds, and high interest savings, I urge you to run the numbers. Remember, if that GIC is yielding 4 or 5% after tax and inflation, the after-tax real rate of return may be unlikely to keep you retired. Now, I'm not saying having these kinds of holdings in your retirement portfolio are bad. Quite the opposite. I believe strongly a portfolio should contain more stable investments that can be relied upon during market uncertainty. However, these must be complemented with owning businesses that have the potential to meet and surpass inflation over the long term. The markets are the greatest wealth building tool in the history of the planet. Think about it. You could invest $100 in a low-cost asset allocation ETF and instantly become an owner of some of the largest, most profitable businesses in the world. It really is wild when you sit back and think about it. Now, an absolutely crucial thing to say here is that I'm not giving you, the listener, specific advice. Your situation is unique, and so too should the retirement portfolio you construct. Your timeline to use the money, your capacity to take risk, and your tolerance for risk must be factored into your portfolio decisions. Myself, as a financial advisor, assess clients' risk capacity, risk tolerance, and timeline as a mandatory requirement by my regulatory body. The conversation about risk is the backbone of the advisor-client relationship and for setting expectations. However, what can be missed in these conversations by some advisors is the devastating impact that being too conservative can have on your retirement sustainability. Like I mentioned before, it may be uncomfortable in the short term to watch some of your investments fluctuate, especially when you need your investments to live off of. But this is why you plan for these events and shift your income withdrawals to stable investments during these periods. I often tell my long-term retiree clients that it's not a matter of if the markets will go down, but when. Accepting this inevitability is a part of being a long-term retirement investor and will give you the confidence and vision to think in terms of decades, not by weekly or monthly market movements. If you want to build a retirement plan that marries the inevitability of a market downturn with a sustainable income for life, I encourage you to check out our website, fundamentalwealth.ca. Okay, so that'll do it for today. Here are your action items for today's episode. First off, if you're the type of investor who never wants to see their money fluctuate and only desires to hold very conservative investments, I encourage you to run the numbers. What is your after-tax real rate of return? If you want to find the calculation, a quick Google will pull it up for you. Second, if your advisor has you sitting primarily in cash or cash-like investments, they are just as bad as a stock picker. No one has a crystal ball, and trying to predict what the market will or will not do is a fool's errand. Whether that be sitting on the sidelines in cash or trying to pick the next best stock. Think like a long-term retirement investor. Check out episode 32 of the podcast to learn more. Lastly, a favor to ask, share this podcast with a friend or on your socials. I appreciate each and every one of you who listen to the show, and the more people that I can help retire and stay retired, the better. Okay, so that'll do it for today's episode. Be sure you sign up for my weekly Retiree in Canada newsletter. Check out our socials on LinkedIn and Facebook. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.